This is Network 18. And you are watching CNBC TV18.
Well, just to run through what went wrong today, in any case, the dollar was strong against most currencies. I mean, the Indonesian rupiah also was 1% lower. The South African rand was about 1.5% lower. So comparable currencies with large current account deficits and not getting flows, all of them were somewhat in the same boat. But 2.3 for us is a real massacre, worse than our peers, you would say, at least for the day. Actually, it was a syndrome of no sellers of rupee. They were buyers. It wasn't as if the people were buying manically, but even for that little bit of demand, there was partly from FIIs who were either taking out money or who were just looking for hedges, or Indian importers, oil importers who have to arrange for purchases. Even for that minimal demand, there weren't any offerings. And as you said, towards the last hour, when client deals are not allowed, a lot of banks were caught short, because normally in that last half hour, the Reserve Bank comes in and really makes the rupee end wherever it wants. So a lot of people, banks which have taken short positions on behalf of their corporate clients, thought they would come in and, cover in that point. But since the Reserve Bank was not offering at any point in time, there was this wonky move towards 63.25 in the dying hours. So basically, that perhaps is not the exact close. If people had not run those positions, maybe we would have closed a little south of 63. But volumes are so thin that if they continue like this, rupee can really go anywhere even tomorrow.
Well, it does seem like it could go anywhere. 63.13 is where it finally closed for the day. Lata, we will come back to you to talk about the bond markets in just a bit. But let me get a quick reaction in from the former Deputy Governor of the Reserve Bank of India, Subir Gokarn. He joins us now on the phone line from Delhi. Mr. Gokarn, appreciate you joining us. As Lata was pointing out, the way that the rupee actually fell today, it looks like it could be headed anywhere. There didn't seem to be any Reserve Bank intervention. The measures that were taken by the government and the Reserve Bank last week don't seem to have stemmed the fall in the rupee. What do you expect from here on?
Well, I think this highlights the fundamental nature of the problem, that anything that's done from the perspective of the short-term, buying time, getting a little breathing space, all of these will do that, but they will be complemented by a strategy that addresses the fundamental issue. The fundamental issue is, as has been said repeatedly, the current account deficit. When we see this kind of a move, as Lata was saying earlier, this means that the dollar is gaining ground against virtually all currencies. And in that thought, you see a sharper move amongst countries that have current account deficits. So we're following the pattern up to here. But then the magnitude of today's move, or for that matter, some of the early moves, do suggest that there is something specific to the Indian situation as well. And that, I think, is coming from two fronts. One is the fact that the current account deficit is relatively large, and the other, perhaps, a reaction to the measures that were announced last week on constraining some capital movements. Although, of course, so far that has not been applied to foreign investors. It's only been applied to domestic, to residents. But there may be some feeling that the next step down this road is restrictions on foreign investors, and if that relief is setting in, then I think it might provide some explanation for the movement we've seen over the last couple of days. It's very important for the government and the Reserve Bank to change the perception, and we're seeing some of that being done by statements made by some government spokespeople.
Mr. Gokarn, if I can just interrupt you there, there are clarifications coming in from the government. The government came out and clarified that, they're not trying to go back to an era of capital controls. There is no move at this point in time to tax FIIs, for instance, or anything of the sort. But that apart, no amount of reassurance seems to be working with this market at this point in time. No amount of reassurance seems to be changing sentiment at this point in time. In fact, there's now talk about a possible downgrade, given the fact that we haven't been able to address the structural issues and what that could mean in terms of the fiscal deficit and the current account deficit with the rupee depreciating in this fashion. There's talk about us going back to the IMF again. The government had clarified earlier, but none of that seems to be going away. It's all stuff that the market is talking about.
Yeah, well, I think as long as it's talk, it's not going to have much of an impact. We need to see some signals. We need to see some action. And this action, I think, needs to come on two fronts. One is certainly the short term. You need to see something that enhances the dollar inflow. This may be an IMF loan, it may be anything else, but something that adds to the potential inflow of dollars, which then provides the system with some comfort that dollar supply is not going to dry up. And this has to be complemented, because otherwise it won't make very much difference, with a credible strategy to address the current account deficit. And there I think we are really coming up against a very, very intractable problem, which is when you add up the total impact of reduced iron ore exports and higher coal imports. That has been a very significant contribution, a very significant contribution to the build-up of the current account deficit for the last 2 years. And unless we have a strategy to address those two issues, everything else that we do on gold or luxury imports and so on is really not going to make that much difference. So it's not going to provide a robust solution. So I think we've got to get to grips with those issues. Now, of course, there is a legal dimension to this, a ruling by the Supreme Court and so on. So it is obviously very complicated, but it's only when we start to come to grips with these complications that there is going to be some comfort provided to the whole investor community that a solution is in at least in prospect. And without that assurance, I think stability is going to be very difficult to achieve.
Absolutely. There doesn't seem to be any comfort in sight as of now. But Jeff Chaudhary, head of emerging equities at FNC Investments, joins us now on the line from London. Jeff, appreciate you joining us. What's happening in the equity markets is very closely linked to what's happening on the rupee. The depreciation in the currency is weighing on the equity market sentiment as well. Another 300-point drop, $54 billion in market cap wiped out over the last 2 trading sessions. What's the India call now?
Well, I think we're in what we would normally call greed and fear mode. I mean, at the moment, the market is fearful, and that's why we're in a bit of a downturn. And it's obviously linked to the rupee, as obviously all your commenters are talking about. The very, very important thing at this point in time is the panic measures, or the measures which will be introduced or should be introduced, should be an incentive for people to put money into India. And that's the key. A number of your commentators have talked about, maybe capital controls or, FII limits. Well, actually, you should be doing the reverse. You should be giving people the incentive to put money into the country. And with the rupee at where it is at this point in time, fundamentally, it's attractive. And so if there's more incentives, people will bring money in particular NRIs. There's a lot of NRI money around the world, and that will come back to India, provided they give an incentive.
Well, the government has been exploring that possibility, Jeff. We don't know whether they are going to go forward with an NRI bond or some sort of an NRI deposit scheme eventually, but that is certainly on the table. But are you looking at putting money into India at this point in time, given where the rupee is, or do you believe that it's best to stay on the sidelines and wait for some stability to return?
I mean, as long-term investors, we don't take views on the rupee based on weekly or even monthly gyrations. What we're seeing is we look at the fundamentals for the country, we look at fundamentals for companies. And over the last 2 or 3 weeks, obviously sentiment has deteriorated significantly, but the long-term outlook for India has not deteriorated, and it's one of sentiment. So what the government really has to do at this point in time, in the short term, is to stabilize the currency. And in my opinion, the way to do that is to make the incentive for people, particularly outside of India, to put money into India. That means temporarily high interest rates for 6 months or 12 months, so the Indian diaspora and foreign institutions say, yeah, the currency is not going to go down very much from here, and I'm going to earn 9% or 10% on my deposits. That's the key.
All right, Jeff Chaudhary, Subir Gokarn, we'll have to leave it there. Appreciate you joining us here with your thoughts on the rupee, the equity markets, and where we could be headed. Elan, there's more.
This is Network 18. And you are watching CNBC TV18.